Hey guys, this is Dawson Discussions, and my name is Nathan Dawson Jr. Today on this episode, I'll be talking about real estate crowdfunding and how I invest in it. So stay tuned. Real estate crowdfunding is a more recent way to invest in commercial real estate, and it has exploded in popularity in the recent years. Crowdfunding real estate can be a lucrative type of real estate investment, but it isn't right for everyone. Crowdfunding refers to a group of people who pool their money together in order to achieve a common goal. Real estate crowdfunding involves a group of investors who each contribute money to a specific real estate deal. For example, if a experienced real estate investor identifies a lucrative opportunity to renovate an apartment building and then sell it at a profit, but doesn't have the necessary capital to do so, they might turn the investment to a crowdfunding opportunity and attempt to raise the rest of the necessary capital funding from investors like you and I. The platform that I invest into crowdfunding real estate is called Fundrise. And of course, I'm not being paid by Fundrise to do this video. So, Fundrise is a Washington, D.C. based financial technology company founded in 2010 that operates an online investment platform. Fundrise was founded in 2010 by brothers Ben and Dan Miller and launched in 2012 before the passing of the Jobs Act, which enacted securities regulation to streamline the process of equity crowdfunding in the United States. So, the Jobs Act, or Jumpstart Our Business Startup Act, it's a law intended to encourage funding of small businesses in the United States of America by easing many of the country's security regulations. It passed with bipartisan, can't pronounce that word, bipartisan support, and was signed into law by President Barack Obama on April 5th, 2012. Title III, also known as the Crowdfund Act, has drawn the most public attention because it creates a way for companies to use crowdfunding to issue securities, something that was not previously permitted. The general idea behind real estate crowdfunding is that when a developer or an experienced real estate professional identifies an investment opportunity, they don't always have the ability or desire to completely fund the investment on their own. So they allow individual investors to contribute some of the project's capital in order to raise enough money to execute the plan. So there are three key players in a crowdfunded real estate investment opportunity. First is the sponsor. The sponsor is the individual company that identifies, plans, and oversees the investment itself. In this case, it's Fundrise. The deal sponsor will facilitate the purchase of an asset, arrange for any contractors or other needed work, arrange the financing, and take responsibility for the eventual sale of the property. Deal sponsors generally contribute some of the project's funding themselves and are also entitled to a certain share of any profits they earn for the deal's investors. Second is the crowdfunding platform. The crowdfunding platform is where the sponsor finds investors to raise the necessary capital for the project, which is the Fundrise website. Think of the platform as the middleman between investors and sponsors. The platform will ensure a deal meets certain standards, advertise the deal to potential investors, guarantee that investors meet the requirements for the investment, and deal with regulatory issues. The platform will also collect investor funds on behalf of the sponsor. Also, same goes with other platforms like Realty Mogul, Diversity Fund, Ground Floor, and others. And finally, you have the investor. The investor, like myself, contributes some of the deal's required capital in exchange for a share of any profits the deal produces. An investor may get some of the income distributions and or be entitled to a proportional payout for an eventual profitable sale. In order to be an investor with Fundrise, you must be a U.S. citizen or permanent resident currently residing in the United States who is over the age of 18. No accreditation is required. Okay, are the fees reasonable? Well, in most passive investment opportunities, the people who play an active role in making investors' money get paid, and this is certainly true in crowdfunded real estate investing. So, a big part of your analysis should be to determine whether the fees are reasonable and whether the sponsor's interests are aligned with your own. Fundrise have an advisory fee. Investors pay a 0.15% annual investment advisory fee, which may be waived under certain circumstances. This means that over a 12-month period, you will pay a $1.50 advisory fee for every $1,000 that you have invested with Fundrise. Separately, the funds in their standard portfolio pay a 0.85% annual asset management fee. So essentially, that's $8.50 a year for every $1,000 you have invested. The advisory fee exists to reimburse Fundrise for the time and money that's invested on your behalf and to build on their industry-leading platform. Things like project level performance reporting, automated dividend distribution system, composite tax management, customer service and investor relations, asset balancing, and fund administration. They manage all of those things and a lot more in house. Their team of engineers, accountants, and other specialists have literally invented new ways of doing the old things that save us, the investors, millions of dollars. Their obsession with doing everything themselves rather than relying on a bloated list of third-party service providers necessitates that they have charged an annual advisory fee, but it's also the main reason why their annual advisory fee is so low, according to their website. There are two main ways a deal sponsor gets paid. There's generally some sort of acquisition fee when the funds has been raised and the property is acquired. The acquisition fee is usually a percentage of the purchase price of the property, and 1% to 2% as standard. The second way a deal sponsor can get paid is known as sponsor return, which is the real money can be made. In most crowdfunding deals, a certain return is paid to the investors before the sponsor gets a dime, known as the preferred return. Beyond the preferred return, the sponsor gets a certain percentage of the returns the investment generates. For example, a deal may pay the first 6% of annualized returns to investors, and the sponsor gets 20% above that amount. In many cases, the sponsor return is a multi-tiered structure designed to motivate the sponsor to produce even higher level returns for investors like me than the project was targeting. The preference is to see deals with relatively low acquisition fees and generously but reasonable sponsor returns. So essentially, you want the sponsor to really be motivated in order to make the investor some money. What is the target return? Crowdfunding deals will generally state a target internal rate of return, or IRR, for their investors. And although the mathematics of IRR are a bit complex, the thing to know is that this is a return metric that combines any expected income from the deal, as well as the expected profits from the eventual sale of the property. One thing to keep in mind is that the target IRR should be taken into account in combination with the rest of the deal's features, and that higher IRR projections are inherently better than lower ones. For example, a lower risk deal with a 14% IRR from an experienced deal sponsor can be a far better investment opportunity than a high risk investment targeting a 20% IRR from a sponsor with less experience. It is also worth noting that many deals have two targeted IRR levels listed. One, you have the project level IRR, and two, the investor IRR. As an investor, you want to pay close attention to the investor IRR, and this is the return the deal sponsor anticipate that the investor will actually receive after they collected any performance-based fees. So essentially with Fundrise, I am investing into a diversified portfolio of real estate projects located throughout the whole entire United States that the team identifies, acquires, and manages on my behalf. I earn returns primarily in two ways: via quarterly dividends and via appreciation in value of the shares in my investment. These returns ultimately come from the individual real estate assets in my portfolio, interest or rent income collected, as well as potential appreciation in the property's value. As a shareholder, I am entitled to my pro rata portion of any returns. Actual results may vary, and there can be no guarantee of enhanced returns due to investment on Fundrise or the use of the Fundrise advisor services. So from August 2019 to August 2020, I was up $542 and without depositing any money and auto reinvesting my dividends, which is a 8.4% increase from my not $800, $500 starter. So currently, as of this recording, I am up $880 from my $500 starter, which is roughly a 76% difference. For me, as long as my investment yield is at least 4% after taxes and inflation, I'm good, since inflation is usually 3.2% annual on average. Of course, higher the return is better, but my main concern is minimally beating inflation after taxes, and the return is at least 4%. Because we can all agree that putting money into a certificate deposit or a high yield savings account is the worst investment vehicle out there with a less than 1% yield. So what is the target holding period? Well, with the most crowdfunded real estate investment opportunities, there's some sort of a target holding period or a time frame for the whole entire investment. This is because crowdfunding investments generally have some type of exit strategy, typically a profitable sale after the property after a certain number of years. For example, a sponsor may plan to acquire an old apartment building, renovate all of the units over a period of 2 years, lease the building up, lease the building at higher returns, and then sell the property after holding it for 4 years. It is important to point out that these are just estimates. There's nothing that obligates a sponsor to complete the investment strategy by a certain time, nor is there anything that prevents them from selling the property sooner than expected. For instance, if the sponsor plans to sell the property after 4 years and there happens to be a recession going on that time, they may decide it's in the best investors' interest to wait. Decide is the investor's best interest to wait. The target holding period is important to include in your analysis because during this time, a crowdfunded real estate investment is generally illiquid, even as far as all real estate investments go, except for publicly traded REITs or real estate investment trusts. So, in other words, if you're going to need money to fund your child's college education in 7 years, then you should only consider investment opportunities with target periods, holding periods that are significantly shorter. So, like all private real estate investments, investing with Fundrise should be viewed as a long-term, 5+ year investment. This is because nearly all of the most effective real estate investing strategies require a combination of both expertise and time to pay off. They select strategies based on their long-term potential for their investors like myself, but not the short-term optics. If you anticipate needing your investment back in the near term, I wouldn't recommend investing with them. Though Fundrise should be viewed as a long-term investment, they understand that investors may want or need to prematurely liquidate or redeem their shares. Accordingly, the investors may request to redeem their shares at any time, although such redemption cannot be guaranteed, especially in the times of economic uncertainty like the current public health crisis going on. And there may be costs associated with premature redemption. And if you liquidate, you'll pay an early redemption fee. So, does the investment have an income component? This one is pretty self-explanatory, but it's worth pointing out. Many investors automatically assume real estate investments will pay income, but that isn't always the case with crowdfunding investments. If you rely on your investments to generate a steady income stream, you need to carefully evaluate a deal's distribution plan. Some crowdfunding deals, for example, don't anticipate paying any distributions to shareholders during the first years. And unlike some income-based real estate investments like REITs, a deal's income projections are just that, a projection. Keep this in mind when you're doing your research. So, with Fundrise, there is an investment strategy called supplemental income that actually seeks to create an attractive, consistent income stream. It aims to earn returns via quarterly dividends with less appreciation, invest in an income-oriented real estate private equity strategy, and target allocates toward assets that produce consistent cash flow. Essentially, Fundrise, they requires assets that generate consistent cash flow. This could mean lending money to a developer of a new property or buying an existing building with tenants in place and collecting rent. They also improve the real estate to increase the margin of safety. To maintain and grow that high income stream, they prefer to invest in a business plan that improves the value of the property. Investors can make more predictable, capture above market returns by increasing the value of the building. And of course, they'll realize returns over time via rent and or interest payments. Unlike a strict growth strategy, which returns are typically back-ended when the property is sold, investors in an income strategy can look forward to earning consistent distributions over time as they collect rent or interest payments. And that is the supplemental income feature, or the supplemental income investment strategy, should you want to employ that strategy with Fundrise. So what are the requirements for investing in a crowdfunded real estate deal? Well, there are a few crowdfunded real estate investments that are open to all investors, but these are generally purely income-focused deals or funds that spread your money among a bunch of different investments like a mutual fund would. The majority of single-asset crowdfunded real estate deals are only open to accredited investors. That means you have either one, at least $1 million in net assets, excluding the value of your primary home, or two, at least $200,000 in annual income. $300,000 in annual income when combined with a spouse's for each of the previous 2 years, and expectation of the same for this year. Now, if you don't meet those requirements, you probably need to focus on deals that are open to all investors, not just the accredited investors. In that case, you have to look for something called unaccredited investors. Now, for single asset crowdfunding deals, minimum investments are at least $25,000. Most platforms, though, require a minimum investment of $50,000. And again, I can't stress this enough, but Fundrise is only for U.S. citizens. So you can actually get started investing with Fundrise by investing $500. So $500 give you started, which is the plan that I've investing in since late last summer or August 2019. The starter account allows investors to invest in the starter portfolio for a minimum investment of $500, and it's the popular choice for new investors who are just getting started with Fundrise and may have less experience investing in private real estate. The benefits include penalty-free redemption options at quarterly intervals, the ability to set up auto invest, and 90 days of advisory fees waived for every friend that I successfully referred to Fundrise. From $1,000, it will give you the basic plan. Get started with a simple real estate portfolio. Start your real estate journey with a basic portfolio of private real estate assets. Dividend reinvestment plus auto invest. Create and manage your investment goals. 3 months of advisory fees waived for each friend I invite. The ability to invest with the IRA through the self-directed IRA, and the potential access to the Fundrise IPO. An IPO is actually the initial public offering. So an IPO is when a company goes public when they want to list their shares on the stock exchange. So Fundrise, since they mentioned this, they're actually going to go public sometime in the future, and it's actually going to be quite interesting on how will this company is going to shake up the real estate industry of the stock market. So can't wait for that, and I'm wondering how that's actually going to turn out. If you have $5,000, you can actually get the core plan. You also want to get benefits for the previous two plans, but you'll also have the ability to customize your investment strategy. Again, customized plans are based on your unique investment objectives, greater diversification across more real estate projects, the ability to direct invest into any of the open electronic REITs, and 180 days of advisory fees waived for every friend that you successfully referred to Fundrise. Speaking of the core investments, one investment I already spoke of earlier, which is the supplemental income investment plan, creates an attractive, consistent income stream aimed to earn returns via quarterly dividends with less appreciation. Invest in an income-oriented real estate private equity strategy. Target allocation towards assets that produce consistent cash flow. So they acquire assets that generate consistent cash flow. Those assets that generate predictable returns from the moment they make the investment. This means lending to the developer of a new property or buying an existing building with tenants in place and collecting rent. They're also going to improve the real estate to increase margin of safety, to maintain and grow a high income stream. They prefer to invest in a business plan that improves the value of the property. Investors can more predictably capture above market returns by increasing the value of a building. And lastly, realize returns over time via rent collection and interest payments. Unlike growth strategy, where returns are typically back-ended when the property is sold, investors in an income strategy can look forward to earning consistent distributions over time as they collect rent or interest payments. Long-term growth. Pursue superior overall returns by investing primarily in high potential growth rental real estate. Aim to earn returns via appreciation and the share value with very few dividends. Invest in a growth-oriented real estate private equity strategy. The target allocation toward assets with potential to increase in value. So essentially with that plan, they're going to acquire assets with a higher potential to grow in value. To capture maximum growth potential in real estate, the key is for them to buy ahead of major demographic or cultural shifts, understanding emerging neighborhood growth or recognize untapped property potential. Then they're going to improve the real estate to increase the sale price. In the real economy, they can create value for hard work. Most classically in real estate, they hope to produce through intelligent zoning, development, and leasing. building new urban housing, and renovating rundown apartments and renting vacant buildings. And lastly, three, the realized returns mostly at the end when they sell the property. There is no greater demand for complete real estate developments. There are many more potential home buyers for a renovated home than a rundown shack, and more renters for new luxury apartments near a metro than for the previously vacant land. And lastly, they have the balanced investing plan. Build wealth confidentially through a mix of cash flowing and growth oriented real estate. Aim to earn returns via a blend of dividends and appreciation. Invest in a balanced mix of income and growth strategies, and target allocations across a broad range of investment types and structures. And now moving on to the rest of the plans. So if you have $10,000 to invest, you can actually get advanced, which means access to more advanced strategy with much higher potential returns. Advanced investors gain access to the plus plans and optional add-on to each core plan. These plans typically allocate a portion of your portfolio to more sophisticated real estate strategies that evolve over time based on new market opportunities. It includes all the core feature plans, plus the ability to allocate directly into most of their e-funds, and they get 9 months of advisory fees waived for each friend that they invite. And lastly, the highest you can go is if you have $100,000, you get the premium service. One of a kind investments paired with unparalleled service. Premium investors can access private e funds that periodically become available. These offerings are usually specialized, truly illiquid private equity funds with even longer time horizons, but carry the potential for outsized performance. Includes all of the advanced features, plus priority access for the fundrise investment team, and 12 months of advisory fees waived for each friend they invite. Moving on to taxes. If you invest in a crowdfunded real estate deal and you make a ton of money, the increased tax bill isn't necessarily a bad problem to have. However, it's better to know what to expect before you are in that situation. Now, with that in mind, there are only four types of taxes you could potentially face as a real estate crowdfunding investor. One, income tax. Rental income generated by the properties you invest can result in a taxable income, which will be reported to you and the IRS on a K-1 tax form each year. The good news is, because of the magic of real estate depreciation, the taxable amounts you see are likely to be lower than the amount that you actually receive. 2. A capital gains tax. When a property sells for more than its purchase price, a capital gains tax is triggered and is owed on your share of the profits. If the investment was held more than a year, this will be subject to long-term capital gains tax. If not, it's going to be considered ordinary income. 3. The depreciation recapture. For real estate investors, depreciation can lower the taxable rental income each year. However, upon the sale of the property, the IRS takes that benefit back. Any cumulative depreciation benefits you will receive will be taxable as ordinary income upon the property sale. This tax is known as the depreciation recapture. 4, and the last one, state taxes, and not necessarily in your own. As a part owner in a property in a different state, that investment falls under its respective state jurisdiction, and all property taxes apply. As an investor in a crowdfunded real estate deal, you're considered to be part of a partnership. Shortly after the end of each tax year, you receive a K-1 tax form that will report your share of the income or loss from the partnership. If there is a loss, you can use it to reduce other forms of passive income, say capital gains or stock dividends, but you generally can't use it to reduce the rest of your taxable income. Also, in most cases, you'll be required to file a state tax return for any partnership income in the state in which the partnership conducts its business. These are general rules, of course, so be sure to consult a tax professional for help. You can expect to receive one or two different types of tax documents depending on the funds you are invested in. With Fundrise, you will receive a Form 1099 div for each REIT in which you own shares in, and a Schedule K1 for any of the e-fund in which you own shares. All right, what's the advantages of investing in crowdfunded real estate? Well, like any investment opportunity, real estate crowdfunding isn't a perfect fit for everyone. There are several potential pros and cons of real estate crowdfunding that should be taken into account before deciding whether it's right for you. First, there's the appreciation. Well, there's the potential for higher returns than you get from any other major asset class. I mentioned before that most crowdfunding deals have been completed have produced annual returns in excess of 14%. It isn't uncommon to see a IRR of 20% or even more from a very successful deal. Crowdfunding real estate can provide an element of diversification to your portfolio. This is especially true if most of your assets is currently invested in stocks, bonds, and cash, as these generally move in a correlated manner. These don't generally move in a correlated manner with real estate. Crowdfunding also gives you the benefits from the potential of single property investment without the headaches of actually becoming a landlord or dealing with renovations yourself. Crowdfunded real estate also allows you to invest in assets that may be otherwise be inaccessible to you. Could you really go out and buy an office tower or a high-rise apartment building? Even if you could, would you know how to go about adding value to the property in a cost-effective manner? Well, crowdfunding allows you to leverage the expertise of others into assets that have historically been the realm of wealthy developers. Most crowdfunding deals focus on a specific property as opposed to real estate investment trusts or REITs, which typically provide a portfolio of many properties. Crowdfunded real estate investments often have an income component as well as a targeted lump sum return at the end of the investment time frame. So, what are the potential downsides of crowdfunding real estate investing? Well, as I said before, there's no such thing as a perfect investment, let alone a perfect real estate investment. It's always important to weigh the pros and cons before making any investment decision. So here is what you should consider before deciding whether crowdfunded real estate investing is right for you. So, no investment that is capable of doing double-digit rates of return is without risk, and crowdfunding real estate is certainly no exception. For me to be perfectly clear, this is a high risk, high reward type of investment. There's a lot of execution risk involved with most of crowdfunding deals, and there's also the inherent risk that comes with investing in a single real estate asset as opposed to a portfolio of properties. Crowdfunding real estate investments are highly illiquid. Once you put your money in, you're pretty much committed for the duration. In this case, with Fundrise, at least 5 years, but probably year 6, you have the ability to cash out or reinvest your capital. Unlike when you own an investment property, you can't just decide to. Unlike when you own an investment property, you just can't decide to sell your investment whenever you want to. Now, is real estate crowdfunding investment right for you? Well, just like how I trying to keep hammering in, like any investment opportunity, real estate crowdfunding isn't a perfect fit for everyone. There are several potential pros and cons, just like how I said earlier, of real estate crowdfunding. So essentially, there's no perfect answer to this question. But one key takeaway is that there's a tremendous amount of variety within the crowdfunding real estate industry in terms of risk tolerance, time commitment, and other factors. So it's likely that there's some form of real estate crowdfunding that's right for you as long as you are a long-term focused investor. So this is my personal thoughts on real estate crowdfunding and Fundrise. So I invested with Fundrise because I wanted to add real estate to my portfolio. Back in August 2019, I didn't have enough money and or probably a strong enough credit to get approved for a mortgage, and I didn't know much about house hacking. That, and I'm much more of a passive investor. I'm more hands off and really don't like a lot of technical work. I'm more of a set and forget it type of investor. Most of my stock and bond investment is all robo-advisor with index funds and ETFs. So in the world of real estate, I wouldn't be a wholesaler, a real estate fix and flipper, or a buy, renovate, repair, rent, refinance, repeat, or the real estate investor during my real estate investing career. So Fundrise is actually my first real estate investment and will not be my last one. I also have public REITs and a dividend sub portfolio plan. Well, I have REITs in a dividend portfolio, which is a sub portion of my portfolio to supplement and then eventually replace my earned income source. As in, it's going to replace my paycheck from my employer and a paycheck from my contracting work, like earned income. And then eventually I will venture into residential rental properties, maybe house hack, and I'm probably considering tax liens and mortgage notes. Again, I'm doing my research, but tax liens and mortgage notes, I heard that they were passive, and I probably look forward to getting into those two, tax liens and mortgage notes, alongside residential rental properties and other commercial properties and house hacking. So in order for me to get started with Fundrise, in August 2019, I invested $500 into Fundrise. From August 2019 to August 2020, I was up $542. And how I did that was I didn't deposit any more money, and with my quarterly dividends, I reinvested them. And then it seems to me that was an 8.4% increase. Currently, as of this recording, I'm up about $880 from my $500 starter um, investment, which is roughly 76% difference between a 500 and then the $880. Um, I did deposit, I think twice. I'm not sure how the math is, but I think I probably deposited maybe once or twice, sometime this year or probably late last year. I'm guessing. So for me, as long as my investment yield is at least 4% after taxes and inflation, then I'm good. Since inflation is again about 3.2% annual on average, of course, having a higher yield is better. But my main concern is mainly beating inflation and taxes and making sure that the return rate is at least 4%. Because we can all agree that again, putting money to a certificate of deposit or keeping it in cash or a higher savings account is the worst investment vehicle out there because of the less than 1% yield, especially in this current rate of interest rates. So once I get it to the $1,000 by May 2021, roughly, I'll have access to some more investment goals, have the IRA investing should I choose them, and the potential to invest in a Fundrise IPO if I want to go that route. Once I have $5,000, then I'll swap to the long-term growth strategy and contribute on a monthly basis and increase my contribution amount yearly. So at first, it's going to be no returns, maybe very small dividends during the first couple of years, but by the close of the 5-year plan, then it should be growing exponentially. So it's going to be 20 to 30% income focused, while the growth real estate assets are going to be 70 to 80%. And lastly, to finally recap this video, real estate crowdfunding is a more recent way to invest in commercial real estate and has exploded in popularity in the recent years, or let alone the decade. Crowdfunding real estate can be a lucrative type of real estate investment, but it's not right for everyone. Crowdfunding refers to a group of people who pool their money together in order to achieve a common goal. I mean, if you're familiar with GoFundMe, then, and if you participate in a GoFundMe, you've participate in a crowdfunding opportunity. But real estate crowdfunding involves a group of investors to contribute money to a specific real estate deal. For example, if an experienced real estate investor identifies a lucrative opportunity to renovate an apartment building, but he don't have the capital to do so, and then once he renovate the property, then he'll sell it for a profit. Then he'll turn the investment to a crowdfunding opportunity and then attempt to raise the necessary capital from investors like you and I. So to finally close out, this is Dawson's Discussions, and my name is Nathan L. Dawson Jr., and this video was my personal commentary and my thoughts on crowdfunding real estate and Fundrise. So stay tuned for my next video, and I will see you later. Oh, and also, if you want to invest in Fundrise, I'm going to leave a affiliate link in my description. And should you want to invest, you'll be able to invest in Fundrise. And I think you might be able to get your advisory fee waived for a few days or a few months, and so will I. So again, my name is Nathan L. Dawson Jr. This is Dawson Discussions, and this is my video on crowdfunding real estate, and I will see you next time. Take care, and I'll see you next time.